Hey, everybody. Welcome to the morning market briefing. It's Tuesday, December 30th, 2025. Man, this is sick. First time in the saddle on the YouTube action. It's a little trippy. I can't quite figure out. There's a camera on me. I don't really know where it is. Is it this one? Okay. And then I'm watching myself, and there's a little bit of a lag, which is really getting in my own head. We got Ben Nye over there with the Sam Frost jersey and the Andrew Hall pants. We're going to do some set redesigns. That's one thing that became very apparent when we upgraded the camera quality and all that good stuff. But I don't know, man. You gave him a shout out yesterday, but Hicks, this is awesome. Very cool. Ben, how we doing?
I'm doing great. I mean, I echo your thoughts. I mean, it's even inside the studio. I mean, it probably doesn't change all that much for people watching, but it looks much more heavy duty, I guess you would say. It reminds us a little bit of, actually, it's very different from what we did at the Venetian, but we're getting there.
Yeah, it's super high tech. I don't know, man. I'm very impressed. We've got
what I would say is the impressive thing is how many different pieces of hardware. As someone who, has a mouse and a keyboard and a monitor and maybe two different types of monitors and a different brand of laptop, sometimes just getting those guys to interact is an absolute pain. And to have multiple different cameras, headphones, computers, soundboards, all syncing up, and that's not a small feat.
And I just want to point out one thing. If the audio sounds bad, it's because I'm real hoarse. It's not Hicks' fault. But the other thing is, I don't know if you experienced this yesterday before the call, but the supercomputer that super producer Hicks has, it sounds like a leaf blower when it gets going on that countdown video. I mean, it is humming. So very powerful. Some are saying the most powerful computer in all of Marietta. So we're excited to be here. We do have a few things to talk about on the market. If you are joining us on the YouTube feed just to kind of check it out, these are kind of trial calls. Feel free to send us emails. Hicks will throw that up on the screen at some point and give us feedback on the setup. We understand the set doesn't look great. We're going to figure that out, maybe even today. But Ben, Meta making an acquisition.
Yeah,
Manus.
$2 billion of this Singapore-based AI startup. Their key product is an AI agent that's built on AI models from Anthropic and Alibaba. So think of this as almost Copilot and versus a large language model in and of itself. And so Meta's purchasing it for $2 billion. I think this is an interesting play by Meta. I always thought the value was actually building the models themselves and then allowing other people to build the agents. But Meta actually purchasing the agent for a pretty lofty sum of money, $2 billion here. What is interesting here is I do think there's a pretty rapid go-to-market proposition with Manus. So right now, Manus, again, is providing this AI agent that helps develop custom-built websites, detailed research reports, things like that. And I think that is going to be something that Meta can easily cross-sell to many, many of its advertisers. So it'll really help Manus scale pretty rapidly. And I do think that Meta can get this to a point where, I mean, just in terms of its client list alone, Meta should be able to get to this to a point where it's returning, delivering return on investment. So I'm very interested to see what Meta ends up doing with this. Zuckerberg historically has not been afraid to splash the cash, but again, he's been really focusing a little bit more on efficiency just in the last couple of months. So I'm curious to see if we see that theme persist with this acquisition.
Interesting story here with Tesla. They've started publishing their Wall Street analyst estimates for deliveries on their website. Just kind of throwing it out there in case people couldn't find it.
Yeah, but they're very different than what Bloomberg has. So Bloomberg has an estimate for the fourth quarter deliveries, and sorry, Jonathan, I didn't put the link to it in the notes, but on the investor relations page of Tesla's website, you can actually go on and they'll have forecasts that go out all the way to 2029 for how many Teslas they're going to deliver based on what the consensus estimate is. Not Tesla's estimate, but Wall Street estimates. So right now, Bloomberg has an estimate of 445,000, which would imply year-over-year deliveries down 10%. Tesla, so Bloomberg it's 445. Tesla's at 422, which is down 15%. So basically, they're cherry picking the lowest numbers, I think, so that they can show that they beat Wall Street estimates. I don't know how they went ahead and cherry picked some of those estimates.
I love it.
But I do think that it probably sets a floor for the quarter deliveries, which again would be down 15% on a year-over-year basis, which I think is reasonably positive for the stock. I also don't know why you do this on December 29th, a couple days before you report Q4 deliveries. But I think they're probably trialing it and want to set a floor for the quarter, which I think will actually support the stock, even though the number is 5% off of where real Wall Street consensus is. I think it's actually going to be supportive for the stock, specifically if they beat. Now, if they miss this, why on earth did you publish these numbers 2 days before you report your actual deliveries?
It's kind of a page out of Kirby Smart's playbook. If you think back to some of the funnier things he has done to motivate his team, in 2021, Georgia wins their first national championship since 1980. So first in a long generation. The following year, rather famously, when they repeated as national champions, undefeated season, had kind of all the key guys coming back on that team. Multiple times he really used the rallying cry of the media thought we would be 7-5. They thought we would be 7-5. Nobody believed in us, man. Nobody thought we could do it, even though they were preseason, I believe, number 1. And then immediately after they surpassed that 7-5 expectation, he was like, "I never said that." He was like, "No, I never said that." But it was very well documented. So I'm curious to see if, in the event that they come in higher than these numbers, are they like, "Oh, well, we didn't make those expectations. We didn't broadcast them."
Yeah, it's really interesting. I mean, I do wonder if other companies are going to take a page out of this book at some point. But Tesla just kind of does a lot of things their own way. So other companies probably won't. And it certainly seems like an endorsement of those numbers because they were cherry picked, even though they will say this is definitely not our estimate. This is just we're just helping investors.
Yeah. All right. Let's let Hicks drive here with some of the tech, but we've got some Dallas Fed survey data, and we'll see if we can get these on screen.
Yeah, I think the big numbers here, this was reported yesterday morning. So this is really a measure of the Texas manufacturing situation, which is different than kind of New York or obviously United States as a whole. But it is relatively up-to-date survey information, which, again, in the absence of other data, is pretty useful for us. So when they came out with the November reading last month, it was conspicuously high. I mean, I think I was very much thinking it was going to be lower because of the government shutdown and everything associated with that. And it was actually a little bit higher than I expected. Well, this month, all of that kind of came back to normal. Production fell back down. New orders fell back a little bit more to trend of what they've been. Hours worked collapsed from a November index reading of positive 9.9 to a December index reading of negative 7.5. The numbers here don't really mean anything, so just, they're going to probably vary between plus 20 or minus 20 over time. You can see the long-term series average for hours worked is 3. So we swung from big positive in November to big negative in December. And I think that's kind of the theme here, is that people are just kind of punting on 2025. And we talked about this in November, that when the government shutdown was dragging on, it didn't seem like anything was going to happen or get started in December. We saw some M&A. We saw the investment banks try to close some deals because they wanted bonuses. But everyone who's actually managing a business said, you know what, I'm just going to punt into 2026 and go from there. And that's exactly what we're seeing in these numbers. If we look at the expectations, however, we can see that new orders are about at trend, which is good and better than the current situation. But what's really interesting here is that is the prices paid situation and the labor situation. So first on the prices paid, and the reason this has relevance is because it has relevance for how the Fed should think about interest rates. Prices paid are coming down. In fact, prices paid for raw materials are now back to pretty much their average throughout history, which would be very consistent with kind of your 2% or a little bit less than that, 1 to 2% inflation. Prices received is also coming down, although that's still a little bit above trend. And then, so basically on the inflation side, inflation numbers coming down. And then on the wages and benefits and employment side, what's interesting here is that employment is decelerating. You see that negative 1.4 relative to last month, but wages are accelerating
quite a bit.
And yeah, and you know what, I see this as people keep talking about it's very difficult to find quality labor. And I think that we're seeing this trend of, yes, you have lower inflation and you probably have lower hiring, but the people that you have on board, you want to keep. You know, we've had so much churn in the market, you know, especially during COVID and immediately post-COVID, that people have now had their employees for a couple years, and the ones that they have, they want to keep now. They don't want to have to keep going through this. They want to plan for a longer term future, and they're going to pay them a little bit more. And so those are two things that I think that we're going to see more of in 2026. We're going to see probably less hiring, but more, you know, if you add value, you're going to be rewarded for that. And I think you're going to see inflation coming down.
Yeah, it's interesting to see just that emphasis on continuity. And I think in some ways those factors probably go together. The difficulty of hiring is going to create pressure on the jobs market, downward pressure in the sense of companies just not wanting to get into it. And that's going to be to the benefit of existing employees.
It's also interesting, you know, we talk a lot about the inability for employees to move, but that also is a detriment to employers who are trying to hire people from a different location. When interest rates are 3%, and you know you have the young professional who bought a house a couple years ago, maybe they shouldn't have bought the house, but they thought they were going to be there for a long time, and you know they hit age of 30, 31, and they want to move, and they have a great opportunity in another city, but they can't afford A, to sell their house, or B, to buy their new house at the current rate. So that's a detriment. The lack of mobility is not just a detriment to employees. It's also a detriment to, in some respects, to employers.
Yeah, that mobility factor, it cuts both ways, especially if you're trying to identify top talent and get them from wherever they may be.
The commentary on the Dallas Fed is also really interesting. We'll just touch on this quickly. In the computer and electronic product manufacturing space, they say we need interest rates to go down further. In fabricated metal products, they say customers are deferring or canceling projects. Again, you know, this push into 2026 is really taking place. And in machinery manufacturing, this is very interesting. They say, quote, hope has arrived. We have big expectations for 2026, and with interest rates down and market steady, we're actually experiencing increasing gross revenue and improving margins for the first time in a very long time. May it continue for a while.
I like it. All right, we'll wrap it up there. We will be back tomorrow. Maybe a big playoff preview tomorrow.
Yeah, let's do it.
We'll do some work on the set maybe today, get things looking a little tighter for you guys. Thanks for going on the adventure with us as we figure all this stuff out. But talk to you soon.